All right, we are officially live. Excited to have a frequent contributor to Rethinking the Dollar. We have Lior Gantz from wealthresearchgroup.com. And before we actually get started, I want to make sure I highlight and mention something that I think will be a great value to you guys. And if you go to wealthresearchgroup.com/virus, you'll get a good understanding as to some of the research and analysis that his team puts together for the community. So, Lior Gantz, welcome back to RTD, my friend.
Thank you for having me.
Well, I appreciate you taking time to join me. So it's, evening time in your neck of the woods, but I want to start off right away. And so you're currently in the Middle East region. And so we all know that there's a health scare going on and can't really say the word or else. But from where you're currently at now, what are you seeing? What are you sensing? And how is that impacting day-to-day life where you're at?
So right now I'm in Tel Aviv. In terms of how the coronavirus is impacting here, the health ministry has announced no entry to the country. So if you're outside of the country, even if you're in Israel, they tell you hold back, stay where you are, and until this blows over. They also did a package of $2.5 billion aid to the economy. I actually took a cab today in the city. The cab driver told me that for 1 hour he did not have any ride in Tel Aviv. This is like someone who's in New York City, being a cab driver and doesn't have a ride for 1 hour. It's they said that in 1 week, if this continues, they'll just stay home. The gasoline and everything else is just killing them. The expenses. Now, and there's hundreds of thousands of people in self quarantine, and this is a 8 million people country. So let's say 5% of the country is in self quarantine or self maintained quarantine. A lot of the elderly people are just saying, "I'll stay home." And order my stuff online, etc., my groceries. But in terms of like a panic, there is none. So it's important to understand that there's a duality that I see in many countries where the authorities are basically taking the lead from the medical experts, which are obviously leaning towards a worst case scenario. So if you see what an epidemiologists are saying, they're saying, hey, this will impact 50 to 70% of the world's population. There will be millions of deaths, etc. What are you going to do as a politician if the World Health Organization is issuing reports like that? And it's important to look at the facts. So there's the virus with its infectiousness and its mortality rates, and what it does. What we can look at is China, where it started, and the fact that they're already kind of going back in terms of their industries and how they overcame it or partially overcame it. And then you also see that their industries are going back to normal, and most people recovered. And then you look at Italy, where the mortality rates are much higher at 5%, not 2%. And the entire country is quarantined now. I think, Mike, with Italy, it's more of a political stunt because that country is mostly bankrupt in terms of like the government, not the private sector. And they're obviously what they're doing is they're trying to squeeze an aid from the World Bank or the IMF or something that is not out of their taxpayers' money. So it's free money to them. The U.S. will pay for it, or the IMF is the other countries in the world that they're not Italy. So I think that's what they're doing. Obviously, there's a problem there, right? But to quarantine the entire country, a country that's based on tourism, I mean that's something out of this world. So you have the virus. You have how the public markets, in other words, the stock market, the free public, how they're dealing with it, and then you have how the authorities are dealing with it. And that salad, that soup between those three, the facts, the worst case scenario maximalists and how they're handling it, the best case scenario minimalists and how they're kind of handling it like it's the flu or something. And us in the middle, the little guy that doesn't control anything apart from what he does personally. So I think that's the style that's happening here, and that's why I wrote wealth360.com/virus, because it goes A to Z on everything. What Trump is doing, what Mike Pence is doing, other countries, Italy. Why this is disruptive? Why this is a huge paradigm shift? No matter what happens, no matter if this is escalating to something that will last beyond the summer or something that gets rebounding fast, there's a true paradigm shift that happened from this. Just like 2008 changed many things for many people, this will also do that. People will be conscious of many things going forward. They'll be conscious of their sanitary and their health and large gatherings. They'll start thinking about large gatherings in a different way.
Yeah.
I think there's a lot of moving parts here, and I'd love to talk about many of them. There's how Trump is handling it, and I'd love to talk about that, how the Democrats are sort of capitalizing on this. Whatever the markets are doing, that's where my main focus is at, and we can obviously chat about that. And personally, this hasn't affected my day-to-day life that much yet. So I'm waiting for it to be closer to home to really sense what this means, but hopefully it won't.
Yeah. Now, so we talk about, I entitled this live stream here, just the meltdown of the markets. And so I actually want to put on the screen right here, so you'll be able to see it as well. And so right now, as we're speaking, the Dow's down 1,259 points. And so there's been fluctuations. One day it goes up, next day it goes down just the same. So what is this a sign of? Is this a part of that paradigm shift if you're referring to when it comes to investing and all those things like that we've talked about in the past?
So there's two things that are really important here. So the Fed has already cut rates by 50 basis points and did an emergency cut. And they did it very prematurely, according to the markets. Now, we can only judge this in retrospect in 2, 3, 4 months from now and see if this was a good move or not. But what I think Trump is doing, he's delaying the big package, the big aid that he will surely provide until the 17th. Because what he doesn't want to do, Mike, just think about it this way. If you were going to propose to your girlfriend and in 1 week and you haven't bought the ring yet, and she's going to make your life harder and going to push you towards that bigger ring because she has time to squeeze you for that bigger ring, right? And that's what he wants. If he unleashes a government blanket and insures homeowners and unemployed people and corporations, gives them all kinds of assurances via the federal government, give that pressure relief for the private sector, then the Fed won't cut rates as much as they will if he doesn't. He wants to put the entire pressure on them, and once it's done, once on the 17th they cut aggressively, then he'll come in and he'll want to be obviously the hero, but not before then. So in the meantime, so
cut aggressively. We're already at a point in a quarter, and so what type of aggressive cut do you see that will be used to insert
at this point? They'll cut by 75 basis points. The federal funds rate will go to 0.5%, and it will probably go to 0 by the end of the year if this goes on. Look, the Fed's fund rate is low historically. It's at interest rates are at 120 year low in general, and at an historic low for the entire world, for the entire history of the world, in terms of global interest rates. So most of the world is already on negative rates. Europe and Japan, etc. Actually, the U.S. has high rates compared to the rest of the world, and that's what Trump is trying to diminish. He wants to make sure that the U.S. is on a level playing field in terms of that, and the reason he wants that is because once interest rates are 0, he can restructure and refinance the national debt for a longer duration, like 50 to 100 years, kick that can down the road forever. But most of all, he wants it because it puts the Fed out of the game. If rates are at zero, then central banks mean nothing. What are they? They don't set interest rate policy anymore. So what are they? And so then the government can come in and do everything they want. Payroll tax cuts, deregulation, infrastructure programs, incentivize troubled opportunity zones, unleash fiscal policy, which is much more inclusive. Obviously, create incentives, tax incentives for companies to move to other states, tax-free zones. You have so many things that the government can do. The government can intervene in terms of opening up what we call government-sponsored entities, where they go into certain industries that are distressed, and they provide the initial capital for building plants.
All right.
There's so many things that they can do.
Okay, so one thing with that thought there. So it looks like you're hinting at there. So I actually pulled up on the screen here a tweet from yesterday, I think 2 days ago, where Trump is very critical of Jerome Powell moving too slow. He says we cut rates, we raise them too fast and cut them too slow. We're behind. We need to take a point advantage with even bigger currency help and stimulate. So you're saying you're saying Trump is setting up the Federal Reserve to take the fall, and then if the government's going to issue something, or what will this be denominated in? Is this a Treasury note coming, or how are they going to stimulate when we're using Federal Reserve notes?
Well, once you cut rates to zero, that's obviously going to help in terms of like liquidity, and the credit markets won't contract and freeze. Otherwise, you'll see a wave of defaults, especially in the energy sector and in the banking sector that basically is the lender for the oil industry. So lowering rates that way is important. Then you have the mortgage markets. Obviously, with 1% interest rate for a 30-year mortgage, there's a lot of people that are refinancing right now. Actually, banks are hiring to handle the load of the people that want to refinance. Companies are going to refinance. So this is actually, you can also say that this is very constructive in terms of an opportunity for companies that are highly leveraged right now and have high costs of debt to lower their cost of debt. So in that sense, that's why lower interest rates are good. The problem with lower interest rates is that they promote all kinds of leverage, which is what we're seeing right now. The reason you're seeing markets tanking this fast, not this much, but this fast, is because of leverage. People have to wind down their leverage positions. Institutions have to wind down their leverage positions. And when you get margin calls, you sell. You just sell. You don't care what you're selling. You don't care if it's Coca-Cola or Procter & Gamble, the best and most stable names. You're selling because you're going to get a margin call, and you need money. You need cash. So that's what's happening. When you ask me what can they also do to stimulate, they can start buying treasury bonds from Washington, from the Treasury, basically expand their balance sheet to be even bigger. And then let's talk about the wild cards here. They can start buying stocks. So that's obviously been, or there's a precedence for this, right? Japan is their central bank owns around half of the stock market in Japan. So there's definitely an historical precedence for this and a modern historical precedent for that. The Fed can also utilize other tools, which are like direct injections to distressed businesses. TARP, right? What is TARP? It's basically injecting money into the banking sector, but they can inject it into the cruise line industry, into hotels, you name it, shipping, airlines, all these distressed industries that have a high correlation. There's so much they can do, but, and I look, these insights, I haven't heard them on any other platform, and you can go to wealthresearchgroup.com/checkmate to really dial down on these. These are my insights about Trump. Mike, what you have to realize about Trump is he went from being a billionaire and the most loved man in New York to being $1 billion in the hole in the 80s. You remember his famous quote where he's walking Fifth Avenue, sees a homeless guy and says, "This guy has $1 billion more than I do." It restructures the debt and becomes a billionaire again. So he knows crisis. He knows how to handle crisis. He knows bankruptcy. He knows all. He doesn't want to be a Republican president that just instantly becomes the mother goose and just bails out Wall Street because of what, right? So he wants CEOs to come into the White House. He wants to talk with them. He wants to see what they do, what they come up with, what the free enterprise system can work as solutions. How are they preparing their companies, their hotels, what can they do? And then the government can help. It can assist. People that say that the government should be minimalized to zero, like in the 1776 constitutional days, that's fine in theory. We're not there, right? 10% of the American people work for the federal government. It's the largest corporation entity on the planet. It's not like we're gonna get those Ron Paul dreams in 1 year from now. It's not where the world's at. And basically, 1 out of every 2 Americans gets some sort of subsidy from the government. So it's not like the American people even want that. It's not going to happen. What Trump is going to try and do is make sure that in these sort of times, he's going to try and make the Democrats look bad for stalling or being political. He's going to say, let's forget about politics for a second. Let's help the American people. And then he'll try to shove through all of the ideas that he had for the first term and some of the ideas that he had for the second term and get less of an objection for them because these are crisis times.
Yeah.
That's what I think will happen. He'll roll the payroll tax cuts. He'll try to roll an infrastructure program. Then he'll try to see what he can do with the national debt. There's things that he's going to want to do. If you're asking me if this is the bottom for what's happening in the stock market, I don't think it is. We had the World Health Organization literally 10 minutes before this interview announced that this is a pandemic.
Yeah.
Now, we already know it's a pandemic, but now that the World Health Organization has announced it and made it official, now it's given excuses to politicians all over to announce states of emergency, close down schools, put the National Guard on the streets, like in Jersey that they're doing. So it's given excuses to politicians to rake it up. All of this is, can you imagine how detrimental this is to the economy? It's absolutely devastating to the economy. You cannot sustain an economy of when 70% of America's economy is consumer economy. You cannot sustain it if nobody can go and shop.
Yeah.
Okay, so you will see a 100% a recession in America. Well, now the whole debate is whether or not it'll be short-lived. Are we looking at a V-shaped recovery that's swift, like in China, where they quarantined 400 million people, and now everything is almost back to normal in many regions? Just consider a general note here. Starbucks has 4,500 branches in mainland China. They had to close down 80% of them because of the virus, and now 90% of them are open. So, people are out there, they're having coffees, and it's happening. People are walking the street. They've handled the worst of it. So, in America, I don't think the sell-off is over.
Yeah.
We came off of a very expensive stock market. But there's a low for this. There's a bottom for it. There's a buyer that will come in, or buyers that will come in and say, hey, compared to bonds, stocks are cheap. I don't care, how expensive they are relative to history. What I care is how expensive they are relative to bonds.
Yeah.
Okay. So when the 10-year bond, which is the barometer for all assets in the world, so the whatever the 10-year bond yields, that's where everything else is priced off of, right? If the 10-year bond is yielding 4 or 5%, most people that are retirees don't have a stock to their name. They just park everything in there, and that's how they live. You have $1 million, you get 40 grand a year, and you live your retirement on 40 grand a year, which is phenomenal, right? Yeah. Those were the 90s and the early 2000s. Today, you don't have that. So if you're a retiree or a pension fund, you have to look at the dividend yield of the S&P 500 being almost 2% and saying, okay, the 500 best companies in the world are giving me a 2% dividend yield, which is 1.7% more than the 10-year Treasury, which
Yeah.
is at about 0.4%, or should I say it's 500% more than the yield on the 10-year Treasury. Plus, these companies are growing at 4, 5, 6% a year. So I'm getting appreciation as well. So relative to bonds, which are the most expensive in history, they're a bubble.
Waiting about.
Yeah, just so people understand, some people don't have a lot of touch to the bonds market. When yields drop, the price of the bond goes up. So if you can, if you're the Treasury Department and you can borrow for 10 years, let's say at 1%, and I'm a lender, I lend you $100,000, and every year I will make $1,000 in income. Okay. Now, when the yield goes to 0.4%, then for every 100,000 that I lend you, I get $400 back. So if I bought that bond last year that yields 1%, how much is it worth when the yield is now 0.4%? Think about it. If the yield dropped, then the price of the bond went higher. If I want today with 0.4% to earn that same $1,000 income, I don't have to lend you $100,000. I have to lend you much more. I have to lend you $250,000, 2.5 times more than before to get that same $1,000 income. So bonds, the more the lower the yield, the higher the price. The price just doesn't justify it, and therefore institutions, not you and I, Mike, but companies that have to manage hundreds of billions of dollars and cannot be in cash because the client will call them and say, hey, what are you doing with my money? They can't just say, no, I'm not doing anything with it. It's cash. Take it. Yeah. Because they work on fees, right? They need to put it somewhere. Where do they put it? They put it in the most liquid markets in the world, the Treasury bond markets. And that's what drives these yields down. These low, unsustainable yields are unsustainable because of one reason. If there's inflation, then you have an inflationary problem immediately. You cannot have 2 or 3% inflation when interest rates are at zero, because that means that everyone's losing 3% a year. Now, some people only make 3% a year because that's a justifiable yield for bonds. So you're looking at a situation right now, Mike, where the world's economy, in terms of yields, are the most vulnerable they've ever been, ever. We wrote about this at wealthresearchgroup.com/reset, about the reset that this can starts to usher in.
Yeah. Now let's talk about some of the places where, so obviously it's a flight to so-called safety in bonds, but yet bonds are, going to be problematic for a lot of people. So what's ideal right now? The metals is not moving, and the crypto sector is not really doing much either. And so they're trying to make it look like there's nowhere to run, nowhere to hide because of this health scare. And so in your personal opinion, for those that have a little something or have nothing, what's an ideal play at this current moment, in your opinion?
Well, first of all, if you have only a little or you don't have nothing, then you don't need to worry too much about where to put your savings because they're minimal. I would say no, I'm being serious. Yeah. I would say your biggest concern is maintaining your active income, making sure that in your career you're being very productive so that you don't get sacked in case the companies start to lay off people. Make sure that you're indispensable at what you do, even if you are a low wage earner and something that doesn't require many skills. Do it to the best of your ability. Be the best one. Yeah. So that's one thing. Secondly, have a plan B. So look at ways to earn money online, earn money from home. There's a few sites for freelancers that are phenomenal, where you can get paid $50 or $100 an hour even for doing something that most people are capable of doing. You need basic Word or Excel or other types of skills, and people that just don't have the time to do some things, they hire freelancers. There are people that are making $3,000, $4,000, $5,000, $6,000 a month from home doing basic stuff like that. virtual assisting and stuff like that's easy, booking stuff for other people, etc., managing appointments. So there are options from home, and it's important for people to know that. So that's one thing. Secondly, if you do have income, or if you do have savings, I think, look, people are feeling that gold should be at 2,500 or $3,000 an ounce, but it's just not that easy. It's not black and white. Gold is holding up really well, Mike.
It's in every currency for the most part, except the dollar. So it's doing quite well.
Yes. Now, just as we're doing this interview, this is on the 11th. In 6 days, the Fed might cut rates by 75 basis points, and then you see what gold does.
Yeah.
You know what I mean? But it's important to also think about this. Look, I wrote about this at wealthresearch.com/gold playbook. It's the most comprehensive gold manual online. It just goes through every aspect of investing in gold.
Yeah.
I don't invest in gold for making gains. So I don't try and buy and sell gold.
Right.
If I want to trade precious metals, I do it with silver. It's much more volatile, and you can use sophisticated options trading and all that kind of stuff. If you want to speculate on that, I own gold in order to take a proportion of my savings and just park them in gold.
Yeah.
For perpetuity. What I did was take 24 months worth of living expenses for my family unit, and I just converted it into physical gold. So if there's a 2-year depression, I have 2 years worth of gold in today's worth, and depression might be their purchasing power might be even more sustained, more prolonged, because things tend to go down. Secondly, many things are a crisis is always an opportunity. In other words, so many things will be different coming out of this. Oil prices, low oil prices are bad for the oil industry and for the banking industry that lends money to the oil industry. But for you and I, it's great. For the economy, it's great. Shipping, travel, commuting, everything is cheaper. Mining is cheaper. Think about it. The ideal world is obviously free energy, right?
Yeah.
Where there's no cost to it. So these are not actually bad things. Lower interest rates, if there's an economy this strong with 160 million people working and one generation, entire generation of millennials that are basically living at home, for them, this could be the start of the migration out of home and into their own affordable housing, whatever the millennials choose to do. They're not going to be like the boomers where they live in the suburbs. They're not the same type, but obviously they're not basement people that will live forever in their parents' house as well. So think about that as well, that this is going to be very stimulative because of low interest rates and because of low oil prices in a consumer economy. Low oil prices are going to lower prices for many things, and obviously competition is going to lower prices. If you're Marriott or Hilton and you see vacant hotels, before you're going to fire people or send them home, you're going to lower the room rates substantially. So a lot of people will take advantage of that. There could be a big surge as we get a relief here. So just remember, a crisis is also an opportunity always on the other side. And think about how you capitalize it in your own little niche or your own little neck of the woods. This could be as a businessman, as an employee, as a side business that you start, many things that you can do. So just keep that in mind, okay? Keep that in mind. And I think if you're trying to capitalize in terms of safe havens, just remember, if most people are invested in stocks and those stocks are going down by 20% and your crypto or your gold is going down by 2 to 3%, you're doing well.
Yeah.
Okay, you're doing well. You don't have to short the markets at the perfect times and generate money from this to call yourself a winner from this crisis. The fact that things are going down and that you're personally got cash on the side and that your income is doing fine, that's a win.
Yeah, good point. Now, as we draw toward the end of our discussion, I'm curious to get your play and your thoughts moving ahead. And so we're now in March. And so this health scare is definitely going to spread continuously and cause more problems. And it's going to cause people to adjust their way of thinking. Therefore, this paradigm shift you're referring to, governments are going to begin printing and easing in a race to the zero. Currencies are going to become problematic as a result of all this. What are you seeing this summer? Or if we get to this summer, this spring, what are some worst case scenarios of what you anticipate in this paradigm shift? Will we have hyperinflationary environments in certain places, or
No,
or
yeah.
you see it?
Look, first of all, you bring up the point of the summer. I assume because the viruses that want to live inside of the host, they die in warmer weather. If that's what you're referring to.
That's what we're told sometimes, but I don't think this is a normal virus. But go ahead.
Yeah, no. If that's why you were bringing up the point of summer, or if it was just arbitrary, look, I don't do short-term whatever predictions in terms of this. What I think is the overall economy was phenomenally strong going into this in the U.S. What I think is going to happen is that CEOs are not going to rely on China as they did before this crisis.
Yeah.
Many plants are going to go back to the U.S. A lot of CEOs will not be able to justify to their board of directors that they stayed in China after all this. So even for saving face and just to say, hey, I did my thing. I moved this back to the U.S. where it's safer. I diversified geographically and politically. I'm not just in China or just in Vietnam, etc. I think that's one thing that's going to happen, and that is costly. To move supply chains is costly, and that's why I don't think this is going to be a quick recovery. There's things that are going to happen here, but in terms of the big picture, we're in a stage demographically where the millennials are entering into peak earning years. And when that happens, when the age group of 34-year-olds to 49-year-olds eclipses the one that comes after it, the 19-year-olds to 34-year-olds, in size and scope, economies boom, productivity accelerates. These people have to form families, they spend more, and in general, that's where we are now. Between 2000 and 2016, we were not in that transition. The group that was 19 to 34, the millennials, were much bigger than the next generation after them, the 34 to 49-year-olds, and therefore you had to have artificial bubbles in order to create productivity and wealth creation. That's why there was a bubble in real estate, because nobody needed houses that much. All these boomers had their houses, had their second houses, so they had their third houses, and the next generation, it was small. But now you're gonna see in the next decade many new families, much more construction. People are going to spend for their newborns, etc. It's in terms of demographics, very healthy right now in the United States. In terms of tech dominance, I don't have to tell you, very dominant. In terms of what Trump has done in the last 4 years with tax cuts and with deregulation, much easier to own a business, operate a business, open a business in America today. And people are coming back from not working for 5 or 6 years. They're coming back to the workforce, and companies are willing to retrain them. They're willing to spend money on retraining employees. So in general, if it had not been for the virus, or for the health scare, we would have been in a very good situation. So just think about that, but also think about the fact that this was not an ordinary event. This was not a December 2018. We hiked interest rates too fast and the markets came down. Now it's going to come back up. This is real. This is something that's not just financial in nature. This is economic in nature. When people stay home, they can't work, when they can't board cruise ships, they can't go to hotels, airlines, sport events. This is real stuff. This is the real economy, and people are going to get hurt, and the government will definitely intervene.
All righty. Well, Lior Gantz, has been great having you here on RTD. It's always exciting to catch up with you and get your thoughts. And so I'm actually going to put on the screen here so people can get a chance to go and see what we're talking about. So wealthresearchgroup.com, go there. A lot of great research articles and whatnot, and opportunities for people to educate themselves. So Lior Gantz, once again, it's been great having you on RTD. Looking forward to continue to connect with you and hopefully have you on in a couple of weeks again and see where we're at and assess and go from there. So once again, Lior Gantz, thanks for joining us on RTD.
Thanks, Mike.
All right, everybody, thanks you for tuning in. Definitely give this video a thumbs up, share this information, check out wealthresearchgroup.com, and definitely see you back for another live stream. Enjoy your day. Peace.